Should you rent or buy in 2025? This is one of the most asked questions. I see why, because with home prices still high, mortgage rates unpredictable, a lot of people feel stuck. So in this video, I'm breaking down housing market predictions, the renting versus buying debate, and how first-time buyers can purchase with no or low money down. By the end, you'll have a clear plan for whether to rent, buy now, or wait, and exactly what programs can help you become a homeowner sooner than you think. Hi, I'm Lisa, the Mortgage and Financial Pro. I've helped home buyers and investors navigate these decisions in real life. I break down mortgages, real estate, and money strategies so you can buy smarter, borrow with confidence, and build long-term wealth. First, let's talk interest rates. Well, still much higher than the historic lows of 2020 and 2021 when rates dipped into the 2% range. Back then, homes felt more affordable because buyers could borrow more for less. This created a surge in demand, but the low inventory of homes couldn't keep up. Toward the end, this dynamic led to a highly competitive market where asking prices spiraled out of control and homes were significantly overpriced. Home prices skyrocketed by nearly 50% in some areas. The resulting run-up in housing costs was a major contributor to the widespread inflation that followed. Today, even the rates have cooled a little from their peak. They're still far above those record lows. Now, on the demand side, people still need homes. Millennials, the largest generation, are hitting their peak buying years. That means even with higher rates, there's steady demand from first-time buyers, growing families, and even investors looking for long-term rentals. Affordability is strained, but demand isn't going away. That's one reason we haven't seen prices collapse. If mortgage rates drop meaningfully, demand will likely spike, and that could push home prices even higher. If rates stay elevated, demand may cool, which would slow down price growth. But here's a catch. Affordability may not actually improve because even if prices stop rising, the cost of borrowing stays high. That's the frustrating reality of this market. There's no perfect setup waiting around the corner. The big takeaway here is this. Don't waste your energy trying to time the housing market. Nobody can perfectly predict rates or prices. Instead, focus on timing your own financial readiness. Ask yourself, is your income stable? Do you have some savings for a down payment and emergency fund? Are you planning to stay in one place for at least a few years? If the answer is yes, then it might be the right time for you to buy, no matter what the headlines say. Should you rent or buy in 2025? Let's break it down, the pros and cons of renting versus buying, and a simple framework to help you figure out what makes sense for your situation. First, renting. Renting definitely has some advantages. The biggest one is flexibility. If you're not sure where you want to live long term, or if your job might take you to another city in the next year or two, renting gives you the freedom to move without a hassle of selling a house. Another benefit, less responsibility. If the water heater breaks or the roof leaks, that's your landlord's problem, not yours. And in some cases, renting can be cheaper upfront because you don't need a down payment, just first month's rent and a deposit. But renting also has its downsides. Number one, rent almost always goes up. You might sign a lease at $2,500 a month today, but next year your landlord could raise it to $2,700 or more. Second, when you rent, you're not building equity. That's $30,000 a year going straight to your landlord instead of helping you own something. And finally, there are no tax benefits. Homeowners often get to write off mortgage interest or property taxes, but renters don't see any of that. Now, let's look at buying. One of the biggest advantages of buying a home is stability. With a fixed rate mortgage, your monthly payment stays predictable, unlike rent that keeps increasing. Owning also lets you build equity. Part of every mortgage payment goes toward paying down your loan, which increases your ownership share in the house. On top of that, real estate historically appreciates over time, so your home value could grow. And of course, there are potential tax benefits that can lower your overall costs. Buying does come with challenges though. The upfront costs are higher. You need money for a down payment, closing costs, moving expenses, and so on. You're also responsible for maintenance, repairs, and property taxes. And unlike renting, owning ties you to one location. So if you need to move quickly, selling a house isn't as simple as breaking a lease. So, how do you know which is right for you? Here's a simple framework. If you plan to stay in one place for at least 3 to 5 years, buying usually makes more sense. That gives you time to build equity and ride out short-term market fluctuations. But if your job or lifestyle is uncertain, or if you don't know where you want to be in the next couple of years, renting might be the smarter choice for now. Let's put some numbers to it. Say you're renting at $2,500 a month. That's $30,000 a year, money that builds zero wealth for you. Now, compare that to buying a home with a $2,800 monthly mortgage. Yes, it's a bit higher, but a portion of that goes toward your principal. Plus, you may see your home appreciate in value over time. That's the key difference. One builds nothing, the other builds long-term wealth. The bottom line is this: renting versus buying isn't about what's happening in the market, as much as it's about your own goals, stability, and timeline. The right choice is the one that fits your life right now. First-time homebuyer loan options. You don't need 20% down to buy a home. In fact, most first-time buyers put down way less. Let's start with the FHA loan. This is one of the most common first-time buyer programs. You only need 3.5% down, and it's flexible if your credit isn't perfect. It's a great option if you're just getting started and want something more forgiving. Next, the USDA loan. This is a zero-down loan designed for rural and suburban areas. If you qualify based on location and income, you could buy a home with no money down at all. VA loan. For veterans and active duty service members, the VA loan is one of the best benefits available. It's also zero down and usually has lower rates with no mortgage insurance. So if you've served, definitely look into this program. There are also conventional loans with just 3% down, like Fannie Mae's Home Ready and Freddie Mac's Home Possible. These are great if you want a flexibility of a conventional loan but don't have a big down payment saved yet. Now let's talk how to buy with low upfront cash. Seller credits. Negotiate to cover some of your closing costs. Gifts from family, allowed on many programs. 401k loans or Roth IRA withdrawals. Creative strategy. 2-1 buy down to lower payments in the first years. Out of these strategies, let me explain how a 2-1 buy down works. A temporary buy down that lowers your mortgage interest rate for the first 2 years. Year 1, rate is 2% lower than no rate. Year 2, rate is 1% lower than no rate. Starting in year 3 and onward, it goes back to full no rate. As an example, let's say the loan amount $400,000, 30-year fixed mortgage, no rate 6.5%. Without a buy down, monthly principal and interest $2,528. With the 2-1 buy down, year 1 rate is 4.5%. That brings you $2,027 per month. Saves you $500 a month, $6,000 in year 1. In year 2, rate 5.5%. That brings you $2,271 per month. Saves you $257 a month, $3,000 in year 2. Year 3 to 30, rate 6.5%. Back to $2,528. Total savings over 2 years is about $9,000. So now, how it's paid for? The seller gives a credit at closing of about $9,000, the exact cost of those interest savings. That money sits in a buy-down escrow account, and it's applied monthly to cover the difference. The buyer gets a lower payment early on without actually changing the loan terms. So it's great for buyers who expect income growth in the next few years. If rates drop and you refinance before year 3, you enjoy the savings and never had to pay the higher rate long term. If you're thinking about buying in 2025, what's your biggest concern right now? Rates, prices, or saving for a down payment? Drop your thoughts in the comments. I'd love to hear your perspective.